Welcome to Indianomics. Lately, many countries have begun imposing anti-dumping duties on Chinese goods. Just within the past month, European Union has imposed on Chinese electric vehicles and maybe will start doing it on Chinese biofuels. India has imposed anti-dumping duty on some capital goods like heavy lifts, and Indonesia is proposing a host of taxes on several goods, garments, toys, furniture, a host of things. A Republican win in the US can mean the mother of all tariff hikes on Chinese goods. What's China done to earn the world's ire? Well, China is expanding manufacturing capacity at a time when its domestic demand at home is very weak. China's investment to GDP ratio, we understand, is 41%. Most of it is going into manufacturing because real estate is broken, so zero into real estate. Now, this is being done to grab export markets, and so the share of China in export markets is increasing, leading to a crashing of prices. China's export price index, we understand, is at 2009 lows. Now, what can be the impact on India and other EMs on global demand if China continues this price undercutting? And how much worse can this situation get in case of a Trump victory, a Republican victory? I have with me two expert economists, experts on the subject. Chetan Ahya, the chief economist of Asia Pacific at Morgan Stanley, and Neelkant Mishra, the chief economist at Axis Bank, also member of India's Prime Minister's Economic Advisory Council. Gentlemen, thank you very much for your time. Chetan, if I may begin with you, how serious is the Chinese undercutting? How serious is the Chinese deflation?
So, Lata, it is a very serious challenge that China is facing. It's already been seeing GDP deflator in deflation for the 6 quarters now. And we think that this challenge is still likely to continue because at the heart of it, the whole approach that the policymakers are going ahead with is to continue to invest more in manufacturing and infrastructure to defend the real GDP growth line at around 5%. And they're not approaching it in the context of this investment by taking a call as to how much is truly needed in manufacturing. But the amount of credit that is flowing into manufacturing and infrastructure is being decided by the fact that there is a gap on growth that is created with real estate slowdown. And so whatever is the gap that is created needs to be filled by investment in manufacturing and infrastructure. Okay. And that approach is resulting into this excess capacity creation, and therefore deflation is persistent. So if you look at some of the new sectors in which they have put up huge excess capacities, solar, batteries, EVs, and even old generation semiconductor chips, prices are down anywhere in the range of 25 to 50%. In solar, it is down as much as 50%. So this is the big deflationary force that is underway right now for the world.
Well, those are the internal well springs that are prompting this kind of excessive output by China. But Neelkant, in the global markets, how dire is the situation?
Well, that's pretty bad as well. Global manufacturing, if you take December 19 as the starting point before the pandemic really started making things volatile, global manufacturing output is up about 8 to 9%. China's manufacturing output is up 32-33%. And so India is kind of keeping pace. It may be slightly above. The US is doing kind of okay. But output is down significantly in the rest of the world. So Japan, Europe, I think things are looking really bad. So global end demand, if you use retail sales as the proxy, real retail sales as the proxy, is kind of stuck at the late 2020, early 2021 levels. And therefore, the demand globally is definitely not growing. But what is most worrying, to add to what Chetan was saying, is that this is not the end of the story. And in fact, some of your opening remarks seem to suggest that what is happening in China is new. frankly, this is something that has been part of their business model, part of their economic model, part of their governance model for a very, very long time. Even in the 1980s and in the 1990s, the decade of the 2000s, this whole model where you have access to a lot of surplus capital because of systematic financial repression. What you do with that capital is what the government decides to do. So they move from real estate to manufacturing, then manufacturing to real estate. So right now they're moving to manufacturing. The difference between the 1980s, 90s, or 2000s, and now, as regards the rest of the world, is that China is now very big. China at that time was not big enough to really move the needle in a meaningful way. But today, on many of these sectors which they are starting to dominate, they are, I think, going to distort returns on assets for many, many economies. One last point here. This is so important systematically to corroborate with data what Chetan was saying. If you see the increase year on year in the trade surplus, goods trade surplus in the month of June, which was about $29 billion, if you annualize that, maybe inappropriate, but just for the sake of argument, it adds up to 1.9% of GDP. So almost 40% of the GDP, if you were to think like, the economy is growing at some 4.8%. So this incremental growth or expansion in the trade surplus is actually a very substantial part of the GDP growth. So it's going to be very hard to roll back. And if this trend continues, where they have added about 1.9 trillion rupees, dollars, in incremental credit to industry, medium to long-term loans to industry, if this growth rate continues, even at a slightly slower pace, in the next 4 to 5 years, they could be adding another $2.5–3 trillion.
Oh my
God. This is not the end of the story. And so I think the response of the rest of the world will also need to be much faster than it has been so far.
Yeah, 2 trillion. I mean, the $2 trillion would mean the entire banking stock of debt in India. That's a great deal. And by the way, yes, it's not new. I remember the late Mr. Vagul told me, I think late 90s or early 2000s, that he was on the board of Williamson Magor, one of the companies which made batteries. And they were saying China is sending batteries here at lesser than the cost of the lead that goes into it. It is, unmakeable at that, unmanufacturable at that price was their point. So yes, it's an old game. But Chetan, you wrote a very detailed piece or several pieces on debt, deleveraging and deflation within China. The persistent slowdown. At some point, you can't keep on making at, higher and higher capital output and lower ROAs. It has to stop at some point even within China.
Yeah, that's right. So, Lata, we recently wrote a piece which was the title of the piece was "What happens if they don't make a change in their policy approach?" Then this is what will happen. The return on investments, new investments will keep declining. You will see this persistence of deflation. And what that does is, two implications. Number one is as your GDP deflators in deflation and normal GDP growth in China is now down to just 4%. That is forcing the corporate sector to think about managing their costs, and they are beginning to cut wage growth. And the same point can be seen another way, is that if the returns are declining in the economy, initially the corporate sector is taking the burden and corporate profitability is deteriorating. But at some point, the corporate sector is going to shift that burden away to the households as well. So, they have the intention to support the bottom 20%. But at some point, this is going to show up on the negative effect of the bottom 20% as well.
Okay.
And then the other challenge that you're going to have is that as the debt to GDP is rising, so debt to GDP in China has gone up by 30 percentage points in the last 3.5 years. They are going to, at some point of time, realize that, look, this is a very sharp rise of debt to GDP, and it's not good for the financial stability of the economy, and therefore pull back on that credit growth and investment in manufacturing and infrastructure. and that will then effectively also result into real GDP growth slowdown.
Okay.
So right now they're defending real GDP growth with this investment, but at some point of time they're going to have to pull back that investment growth as well,
But
and therefore
it
take
can
the
take a
loss
while,
on
you
it.
think?
Yeah, it will take some time, but we are seeing some early signs of them beginning to slow credit growth. We also heard in the Politburo meeting this week, they did mention about boosting domestic demand with consumption. So there is a very early sign of them realizing that this may not sustain for too long. But yeah, at least I think definitely will take some time before you get the solution to this challenge. And at least in the next, I would say, 12 to 18 months, we will still have to be contended with this, creation of excess capacity that is ongoing.
Okay, I'll come to the impact of that in a minute. But Neelkant, which are the sectors that will get impacted? Just a little while ago, Mr. Narendran of Tata Steel was on speaking on his results, and he said that Chinese are selling HR coils at $50 to $60 lower than their own cost, is what he said. So it's selling it at a loss, which obviously is not sustainable, he said. But which are the sectors where India can get hit, where the world can get hit?
Yeah, so let me first clarify that whole point about return on assets and profits. I mean, these are very, very capitalistic, very bourgeois terms. I think, and I'm not being cynical here. The whole economic model, see, what is GVA? Gross value added is profits plus wages. And so if you are through systematic financial repression, if you are able to get all the money into the banking system, which is primarily state-owned, what is the need to make profits?
Okay.
And this is not a cynical, rhetorical question. It is, the problem is that when we analyze their economy, we are using the lens that we are used to.
Yeah.
Remember that in 2003-04, the Chinese government had to recapitalize their banks with 1/3 of GDP of capital, which means that 1/3 of GDP that was being counted or had been created in the prior years was actually wasted. In the year 1986, Chinese steel companies made 50 million tons of steel. Only 5 million tons was useful. They had to import 20 million tons of steel to meet the needs. In 1996, they had 16 million TVs surplus, 1.3 billion shirts surplus. So this is not the first time this is happening. And so we have to just understand that this is a very different economic model of governance.
Yeah.
And therefore, waiting that, nahi chalega, see, that's not how this economy works.
Yeah.
And therefore, the fact that they're producing at 60 or selling at $60 lower is actually not very relevant. I mean, it's very relevant for Indian companies. I mean, how can anyone do that? But in the Chinese economic model, it runs the way it does.
Yeah.
So I don't think this is slowing. Now, which are the sectors worst affected? I mean, so we've discussed quite a few already. The solar
panels, yes.
Energy like panels, batteries, electric vehicles. You look at what has happened to the profit margins of European car manufacturers. Already Chinese EVs are 11% of the EV market in Europe, and I think they're going to get bigger. Look at what has happened to some of the US automakers' profit margins. Look at what's happening to chemicals companies. So I think in every sector, you look at what is happening to Thai companies. You're look at what is happening to Latin American companies. So what is another interesting aspect is that the growth in China's trade surplus is no longer to US and Europe. A lot of the surplus is increasing. So out of the $29 billion that increased from June 24 to June 23, like 23 to 24, $8 billion was to ASEAN.
Okay.
So I think the geographies where these exports are headed, some of them could be rerouted to the developed markets. I mean, that is possible. As well as the sectors are, I think, very well identified. I don't think we need to be very careful and very creative in figuring out where this is headed.
Yeah, I guess, and it's also country-wise. I just read Indonesia earlier this month wants to put 100 to 200% tariffs on a whole range of things. You know, toys, garments, footwear, a whole host of things because they are losing jobs there to Chinese products. But Chetan, what about the macros? I mean, India is celebrating a fall in core inflation. But if core keeps on falling, it almost looks deflationary. How does this impact monetary policy? Can there be missteps in monetary policy? How do you expect? Do you think we can see central banks starting to cut rates?
Look, I think first of all, in terms of deflationary pressures to India, I think to the extent to which the government is taking a lot of precaution in protecting to avoid that there is not much of a dumping. So, for example, you can't get EVs imported into India.
Yes.
So there is that control being already in place. I don't think there will be a misstep in India because of deflationary forces coming in from China.
Okay.
Currently, our view on the central bank policy path is that the RBI needs to stay put, and it's not something that we are making as a forecast. I mean, we did before the last monetary policy meeting itself, the call that they will not be cutting interest rates.
Yeah.
But I think there are two issues that are going to hold back central bank from cutting rates. Number one is we don't think that inflation will go down to 4% sustainably. Yes, the core inflation is down to below 4%.
3 and sub 3.
It's up 3, but Lata, some of the components there are something that we feel that the statistical agency is taking time to incorporate.
Okay.
For example, rental inflation is so low.
Fair point.
It doesn't seem to be right. So maybe core inflation actually, once the data gets marked up correctly, shows up higher. But more importantly, it is a challenge in India to get food inflation down sustainably to below 4% or 4%.
Yep.
And so we think that it will not be possible to get 4% inflation sustainably, and therefore RBI needs to hold policy rates at 6.5.
Okay.
And more importantly, we have a practical issue where you have a 3 percentage point gap between deposit growth and credit growth.
Yes.
And if the RBI cuts interest rates, then the message from the central bank would be, while I'm asking the boards of the central bank to bridge the gap between credit growth and deposit growth, but here it is. I'm cutting interest rates. You should cut deposit rates and lending rates, and forget about bridging the gap. So I think there is also that challenge. Yes. And 16-15% credit growth is pretty decent. So I think there is no need to cut rates to stimulate growth, and growth is holding up back quite fine.
Fair point. Fair point. India will have other reasons why they cannot cut rates immediately. But I wanted to discuss more the Chinese impact on global growth itself, because we will be guided or impacted by global growth. And then we have still not discussed the elephant in the room. What happens if the mother of all tariff hikes comes with a Republican government in the US? Both those sets of questions after a very quick break. I'm back.